So I want to talk a bit about liquidity. And liquidity is a very simple concept, but I think that it's a good one to start with. And liquidity really refers to the ease at which you can buy and sell something. So it is a bit misused and abused, I think. It's been a little manipulated. For example, right now we're hearing the Federal Reserve talk quite a bit about liquidity and that they're creating liquidity by creating more currency effectively and putting that out there in the world market. Um, that to me is more about volume more than liquidity because the dollars, having more dollars doesn't make them more or less liquid. Whether I have a tattered $1 bill or you have a crisp new one, they both buy the same amount and they're both as liquid. So for example, and the dollar, by the way, is a commodity because for that, by definition, a dollar is a dollar. And your dollar is no better than mine. The purchasing power is exactly the same. But we use currency as a medium of exchange because it's more efficient than barter. And now we have a very elaborate monetary system which has its own problems and I won't get into. You can follow somebody like George Gammon, does a really good job of talking about that. He's already done that work. So let's give you an example here. So liquidity, okay? I've got two charts here, and one is very ragged looking. That's the lighter blue. The other is a darker shade, and the darker, less volatile, less jagged chart refers to the Seattle Housing Index. So I live in the Seattle area, and we have a cyclical market, Jason Hartman would call it. And so it's basically more volatile than, say, Middle America or the Rust Belt or someplace like that. If you look at where this bottomed, all right, and it's kind of hard to see here because I didn't put the years, but just take my word for it. You can see a very obvious bottom with that jagged light blue chart. And the jagged light blue chart is ticker symbol ESS. That's Essex Property Trust, which is a publicly traded real estate investment trust. So they own many West Coast properties, apartment complexes. And so that is a publicly traded REIT. That means that if you want to buy it on the New York Stock Exchange or wherever it trades, you'll see a lot of volatility in the price because with modern trading, a stock's price can change by the minute basically. So you can see that it bottomed in around 2009. Whereas this, and so I'm using that REIT as sort of a proxy for West Coast real estate. And then I compare that to the Seattle Housing Index, which didn't really bottom until about 2012. So you can see the bottom for Seattle Housing Index is over the word money, the O. That's about 2012, and 2009 is where the ESS REIT bottomed over the word bias. So the word bias is roughly 2009, and the O in money is about 2012. But you see that the patterns, they're very similar actually. I mean, they both had a fairly steady rise over the years, and they hit a peak around whatever, 2006 or so. And then the REIT kind of did a drop, and then it popped back up, and then it really took a dive and bottomed in 2009. And granted, that's when the stock market in general took a bottom. But what does ESS represent? It represents publicly traded company shares on the stock market of West Coast real estate. People live in these apartments. It doesn't mean that the rents of the apartment complex dropped radically overnight. You need to actually see people moving for that to happen, right? You need to see supply and demand in reality. In the stock market, supply and demand is how many shares are for sale at the same time, how many are, want to do people want to buy. So if there's a thousand shares for sale against 2,000 to buy, it's relatively more popular to buy than sell, and so that raises the price. So you can see the price rise every minute. And because it is liquid, it is easy to buy and sell. If people go into panic mode and they all want to bail on a stock, you'll see that stock drop like a rock, like we did in 1987, like we did back in 2009. You're not going to see that with the actual apartments themselves in terms of the rents because people can't just move overnight, right? They can't move by the minute. So it'll take a few years. So I don't have a chart of the actual apartments, but I would imagine that if I could put the rent index for Seattle in here, that it would fall somewhere in between. So yes, the REIT fell because the whole stock market fell in 2009. It found its bottom, but then it started to climb slowly and steadily. And the Seattle Housing Index didn't bottom until 2012. Why is that? Because a house, which is also a dwelling, is not as liquid. It's not as simple to just sell your house. I mean, you got to move, you got your kids have school. It's a complicated thing. Also, people are stubborn, right? I mean, people don't want to sell if they don't have to because they don't like the idea of selling for a loss. So I'm using this example to show relative liquidity. Okay, so the control here is uh, houses or housing, but some forms of housing are more liquid than others. Likewise, if you were to somehow acquire shares in a privately owned company that doesn't trade on a public exchange, you can expect to see, well, you really couldn't sell it, actually. I mean, you don't have a public market to sell it. So unless they have an IPO and they go public, you're kind of stuck with it. But you also won't see that kind of volatility that you would see in the stock market as well. So it's been said that the market is driven by liquidity, and I'll let you do a little research and figure out if you think that is true. So this is a very simple concept, but I think it's a very good place to start because it's going to come up later.